Howdy, Jacob here. Today we're looking at Wabash National Corporation in the machinery industry. 1.2 billion market cap on just under 1.5 billion enterprise value. Been around since 1985. It looks like they provide solutions for transportation, logistics, and such. Growth has not been super sexy over the last 10 years, but little growth can still lead to a fantastic investment. 1.9 billion revenue to 2.5 billion. Post COVID, there were some huge increases like other logistics companies, and it slowed down just like other logistic companies. But their earnings per share has actually well expanded, so that's kind of impressive there. We see on the operating margin side, we're actually seeing 12%, which is what their gross margin was in 2014. So very impressive margins. Return on invested capital most recent year is 26%, probably averaging low double digits. So still pretty solid, well above their weighted average cost of capital. So they are producing business, which is good. Their balance sheet doesn't want to load. Okay, finally got to load. So 179 million cash and cash equivalents with 396 million long-term debt, no short-term debt. We're looking at about 200 million net debt. And in relation to their 5-year average free cash flow of over 100 million, that's pretty low. A couple years, less than 3 years of their 5-year average free cash flow to pay off that debt. So no concern on that balance sheet. The debt is not substantive. We're not worried about that. We do see a little bit of reinvestment, which is seen through their capital expenditures growing quite a bit. And outside of this big acquisition in 2017, the use of cash is mostly just their dividend and share repurchases, with their debt payment also going down quite a bit. So that acquisition they did fund through issuing debt, but outside of that, the last 6 years they've paid that down. So I think they're in a good situation from a debt perspective. I think that if the company shares are stupendously cheap, we do want them to be buying back as many shares as possible. Dividend is pretty consistent. Let's see on a per share basis. Yep, they kept it flat the last 5 years. So I think we're ready to start making some assumptions here. I think on the revenue growth side, just a little bit more in inflation due to them being able to possibly reinvest back a little bit into themselves, and then possibly acquisitions that hopefully make their business more efficient. For margins, we're not looking at very sexy margins here. They're pretty low, but that doesn't mean you can't get a great return as well, since everything's the present value of earnings and free cash flow. So you just got to buy it at the right price. And I think maybe let's do 3.5% and 4%. Kind of low, but I think on an average basis, I'm pretty comfortable with that. Share change, they have a market cap of 1.2 billion. So 1% would be 12 million. 50 million would be about 4%. And I mean, the company's historically used about half their free cash flow to buy back shares. So I think 4% does seem reasonable for share repurchases. So about exclude or to offset stock-based compensation as well, you're looking at about 60 million, which again, I think that they can afford that. So let's do 4% of shares. PE, I mean, do I think they deserve a moat? I don't know if I do. I think low margin, yeah, it's gone like crazy. Margins are crazy recently in relation to itself, but I do think low margin businesses can be very tough, on inflation and everything. So I do think that a market average of 15 seems appropriate to me. And then they haven't increased their dividends. So this is saying about 50%, 60% of their free cash flow goes towards share repurchases, about 20 or so to their dividend, and then the remaining is just reinvesting in acquisition. I think I'm comfortable with that. And that gets us to a price point that needs to fall 20%. So really not too far off before I got to do more research and see what a good price is. So hopefully you enjoy the video and have a great rest of your day. Thank you.